This video is part of the ICT One Trading Setup for Life series where I go over setups and strategies that ICT recommends in one of his videos titled ICT One Trading Setup for Life. I'll be covering my favorite 3 setups in this series in a simple way, so make sure to watch the other videos too. If anyone needs a one-on-one mentorship, check out the description. This is Mulham and let's get into it. So starting with the first setup that we're going to discuss in this series is going to be the PM session sweep. So we're going to be focusing on specific levels of liquidity in a specific time. And this setup, I recommend only using one pair, and I would reveal that in the next slide. But this is a very easy, maybe 3 to 4 steps, and you will have a high win rate setup, only using one time frame, one specific level of liquidity, and also one specific pair. So first of all, talking about the pair, this setup is mainly on indices. It's not going to be applicable on Forex, only on indices. And based on my backtesting and also based on what ICT is doing, I really recommend sticking with S&P 500. As I said, I backtested the setup on S&P 500, NASDAQ, and also Dow Jones. And S&P 500 is by far the best when it comes to results. So I really suggest sticking to S&P 500. If you really want to give a try to the other pairs, you can. But based on my backtesting, this is the best pair. Today's video is sponsored by Hanko Trade, one of the best brokers in the business with spread as low as 0, low commission, and you can trade all markets, including Forex, indices, and crypto. And if you use the link in the description, you will get an exclusive 100% bonus. Make sure not to miss it. Let's get back to the video. Now, talking about the strategy in a very simple way. I'll explain it in a very simple way. And remember that you can always be flexible with it. You can always make your changes because that's how people be successful. You learn from someone, you put your own touch based on your backtesting, you adjust it a little bit, make it better. That's the real way, because you'll realize a lot of stuff when it comes to backtesting that I will not teach you in this video. So backtesting will tell you much more. So the first step is knowing the PM session. So what is the PM session? It is from 13:30, which is 1:30 p.m. Eastern time, all the way to 16 or 4 p.m. Eastern time. This is the PM session. We're going to be using the regular trading hours chart on TradingView, and we'll have a gap here. So there'll be a gap here until 9:30 where the market opens. So in this PM session range, we're going to mark the lowest low, which is right here. This is the lowest low in this range, and this is the highest high in this range. Now we're going to be identifying the bias, the order flow, and the drawn liquidity. So let's say that based on the higher time frame analysis and based on the order blocks, fair value gaps, the daily bias, all of those analysis on the higher time frame, it's telling us that price wants to go lower. Because price wants to go lower, where is the fuel in the market? In this case, it's the PM session high, this buy side liquidity from the PM session. So before price going lower, it wants to take some liquidity, which in this case, price taking the high of the PM session, then going lower. This setup is not a high probability if you don't apply the higher time frame analysis. Without the daily bias, without the analysis of the order flow, it's not going to be a high probability. So we're going to be marking the highest high and the lowest low. And after 9:30, all the way to 11 or 12. And we're going to discuss this later. But me, myself, I suggest sticking to 11, but you can do 12. So 9:30 to 12, this is where you try to find your entry only on the 5 minutes time frame. So what are we going to look on the 5 minutes? And as I said, you can always be flexible. Those are my suggestions. Even ICT himself did not suggest specific time frames. This is all from me. So 5-minute time frame, price opening at the 9:30, going up, price coming lower, going up and taking the PM session high in this case. But what do we see here? What do we notice right here? A V shape, an inverse of a V shape. In other words, price getting out of the range and coming back immediately to the range. So it's just a fake out above the range and then coming back immediately, which means also that there was no displacement above the range, but there is a displacement below the range. Coming back into the range, there is a displacement. So when I see this price coming back into the range, I would know that, okay, mostly we're having a trading opportunity here. What do we wait for? We wait for a displacement and a fair value gap. And I prefer if there is a change of character or market structure shift, that's always going to be better. So a change of character, market structure shift is a plus, but the main thing is a displacement with a fair value gap. What do? We enter from that fair value gap. Here's the fair value gap. And you can always be flexible. What I'm going to be doing here is just have a sell limit at the 50% of the fair value gap. You can have a sell limit at the beginning of the fair value gap, or you can look for a lower time frame entry, which means that we're using the 5-minute now. What you can do is go to the 1-minute time frame, look for another change of character and a fair value gap and enter from there, which is another confirmation inside of a confirmation. Or you can simply wait for an engulfing candle, like a bearish engulfing candle in this case, and enter from it. A lot of entries types, a lot of ways to enter. So always find your way. But today we're going to stick to the simplest one, which is just entering from a 50% of a fair value gap. Price continues going lower. What do we target? The first target is the PM session low. So when PM session high is taken, we target the PM session low. When the PM session low is taken, then we target the PM session high. And then if it's like, I would say 1-to-1 or 1.5-to-1, then it's not worth it to target the PM session low. So it's either not taking the trade or take the trade and target more based on the high time frame analysis. So if there is a drawn liquidity level below the PM session low and is giving you a better reward to risk, then you can take it. Now, where do we have the stop loss? You see this high right here? You could have it above the high of the manipulation or the fake out. Or what you can do is, you see a fair value gap. We know that a fair value gap is a 3-candle pattern. So the second candle has the fair value gap, right? What we can do in this case is have the stop loss above the first candle of the fair value gap. So here is a candle. Then there is the first candle of the fair value gap. So we can have it above the high of the first candle of the fair value gap. And then, as I said, we target the PM session low. And now if we flip this and we have a buying opportunity, which means that the bias was to go long, what do we look? A fake out to the lower side to go up. That's the fuel of the market. What do you want to see here? Price taking the PM session low, displacing above fair value gap to enter from, price come back into the fair value gap, and we target the PM session high. It's literally the same. You just flip it. Now, to summarize the steps and have them in a written way, we first identify the bias and the drawn liquidity. This is the most important step. And without this, the setup win rate is going to go much lower. For example, 75% or 60% win rate, then it's going to go to 40% win rate if you don't apply this. In my opinion, bias, higher time frame, point of interest, all of those stuff will take your strategy or any strategy in the world to 20 to 30% more win rate. Then we mark the highest high and lowest low between 13:30, which is 1:30 p.m., and 16, which is 4 p.m. Eastern time. Then we wait for price to sweep the side that is aligning with the identified bias. So for the first step, if you identify the bias as bullish, then I would wait for the PM session low to be taken to go up. That's what I mean by this step right here, the third one. And fourth one, we wait for a fair value gap with displacement. And I prefer if there is a market shift and we enter from that fair value gap, targeting first the opposite PM liquidity level, the PM liquidity, and then we can look for the other liquidity levels either on the higher time frame, if there is internal to external, or the op. Now, this is just for me what I suggested as the entry. This is my preference. I do enter from 9:30 to 11, and then I can hold the trade all the way to the PM session and can hold it more, but you can extend it to 12. And we're going to discuss this. We see that sometime you'll be missing trades if you only take it until 11, but there are also some time where you will lose a trade if you take it after 11. So it's a two-sided thing. Sometime you'll be losing, sometime you would be missing the trade. So it's your decision at the end. Me myself, I prefer to stick to 11. Now, going over some examples right now to ensure the understanding is fully there. What do we see here? So, first of all, this is the PM session, the orange box, and the blue one. This one is the 9:30 to 11, right? This is my preference for the time. Now, in this day, what do we see? This is the 5 minute time frame of the S&P 500. From the 5 minute itself, I can see that it was going lower and it wanted to go lower. There is a fair value gap all the way here. The only fair value gap, there is one right here, but there is the extreme one right here. In this case, what do we have below the fair value gap? A PM session high, which is a level of liquidity that needs to be taken in order for price to go lower most of the time. So price opens at 9:30, goes up all the way into the fair value gap, and there is a big rejection here, which tell me that, oh, this fair value gap is kind of valid, and it already took the PM session high. Price into the fair value gap, some consolidation here, another touch into the fair value gap, but lower than the first one, and then it started going lower. And here's the displacement. There is this displacement right here, this displacement leg right here with the fair value gap, and it's inside of the time that we enter trades. So singular fair value gap, and we can consider this as a change of character right here, this low. And we have a fair value gap here, which can act as an inverse fair value gap in the future. And this inverse fair value gap right here can be an indication of a market structure shift if it's just restricted. And you see a body closure below the fair value gap. So that's an indication also of a market structure shift. Now we have this fair value gap. We enter from the 50% of the fair value gap. We have the stop loss above the highest candle in the fair value gap. This is the first candle, stop loss above, targeting the PM session low and maybe further, but only targeting the PM session low would give you 2.3 reward to risk, which is still good, but you could have gotten much more. So having a fair value gap above the PM session or below the PM session, it's the best thing to look for. Fair value gap below, above the range. And you wait for price to sweep the liquidity into the fair value gap. Now, another example right here. What do we have? We can see that price was going up, price coming lower. And then where did price open? So here is the gap, and price opened above the PM session high and above this high, and it was starting to go lower. Created this low right here, started going up, and then it broke this low right here. And this can be a market structure shift. So now we can know that, oh, price is starting to go lower after breaking this low, and there is a good displacement right here. Do we have a fair value gap in this leg? Yes, we have this fair value gap right here. And we can see that price come into the fair value gap. But here is the thing. But in this time, price did not come to the fair value gap before 11, but it was before 12. You see, 12 is right here. It was before 12, but it was even a better trade. Why? Because we have a fair value gap right here and an inducement. So there is a low that is aligning with this high of a candle in the fair value gap, and then price come into there, sweeping the level of liquidity into the fair value gap and going lower. So the first candle right here is respecting the fair value gap, and you can see that it closes out of the fair value gap. The next candle is a very big candle, and it's already, more than 3R just by this candle. Then continuing to the lower side all the way to the PM session. This trade, because price was all the way above the PM session high, and you see where the stop loss is, above the first candle of the fair value gap. Price taking the PM session low, and this is an 8 reward to risk trade. Very huge trade all the way to the PM session low, and it continued to the lower side. So in this day, if you were just sticking to 11 a.m., then you're not going to have the trade. But before 12, you could see that it was a very clean trade, an inducement and a fair value gap, and then above the PM session high, taking the PM session high, going to the PM session low. This is a very nice trade. Now, as we know, all strategies have winning and losing. So this is a losing trade to learn from, and it's part of the game. If we don't have losing trades, then we're not going to say, oh, 60% win rate, 70% win rate, because we're going to be saying 100% win rate. So losing is part of the game. This is a losing trade to learn from. We had PM session low right here. We had PM session high, but price opened up all the way up, did not respect the PM session, took this high instead, and then started to go in lower. So we could always look for prices above the PM session high. We could look for another level of liquidity above it. Maybe price will react from there, because sometimes price want to take another level of liquidity. So in this case, it took this high too, started going lower, and it created the fair value gap here. So I'll be entering from the 50% of the fair value gap, stop loss above the highest candle of the fair value gap, targeting the PM session low, but this is a losing trade. Now, this is part of the game. Losing is part of the game. Usually, even if I see this, I would still enter. Why? Because price did create this low, and we have this low also, and this low, and this is the PM session low. So we have almost equal lows, I would say, and I would want those to be cleared. And also we have this low, right? So almost 4 lows that needs to be taken, but unfortunately the price took this and then continued to the lower side. So losing is part of the game. And I just wanted to show you a losing trade, because even me using this, I lost some time and I won some time. But what we are focusing on is at the end of the month, what am I getting? Am I losing or am I winning? Now, as we discussed the losing trade, there's also another possibility, which is price going up without triggering your entry. So what do we have here? PM session low. Here is the lowest low. And then price opens below. There is no fair value gap, no displacement, nothing until this low is taken. Then it continued to the lower side. And before 11, there was a market structure shift above this high and this high with a fair value gap. So my entry would be right here, stop loss below this low, and take profit. First one is at this level. But unfortunately, price only come here at this fair value gap and shoots up. So do not be mad when you see this, because this is also part of the game. That's the same as losing and the same as winning. So always keep your heads up. And this is the last example. This is the same as the first example. So 5 minutes, S&P 500, the same thing. We have PM session. This is the box of the PM session. We have a fair value gap above, a very big fair value gap. Now, where does price open after the 930? 930 opens all the way into the fair value gap. You see how the 50% of the fair value gap is respected here, respected here, respected here, respected here. So it tells you that the fair value gap is being respected. Also, why? Because you see the candles. This is a bullish candle. This is a bearish candle. This is a more bearish candle. And this is closing also below. And this is a candle with displacement creating a fair value gap. So this would be my entry here, 50% of the candle. I got my entry here, and then targeting the PM session low and maybe more. This is, I think this was like a 2 to 1, or no, it was more 2.5, but you could have gotten much more profit, So if you have PM session and a big fair value gap above, this is also a high probability trade right here. And this is what I always, make sure. And I always look at the candles when price going into a fair value gap. You see how it's really telling you a story here. Candlesticks tell you a story. Price closing below, still a bullish candle. I'm not saying it's a bullish candle, but I'm saying the color of the candle is bullish. But for me, this is a bearish candle. Why? Because it's at a fair value gap. And you see this wick? This is for me as a bearish candle. And then another bearish candle, red color, and then also another bearish candle. Why is this? This is a green color, but it's a bearish candle. Why? Because it took this liquidity level of the previous candle and then it went lower. So it's a bearish candle for me. And then this is for sure is a bearish candle. Displacement with a fair value gap. You get the entry here. You see how it's a zero drawdown entry. Coming lower, coming lower, coming lower, and you get your take profit. Now, finally, how to have a high win rate with this strategy. As I said, it's not going to be as 1 + 1 = 2. No, you got to master the strategy and you got to put the time, the effort, and you need to align it with the higher time frame. So first of all, the trade needs to align with the higher time frame bias and the order flow. Second thing is that the PM session, it's got to be a range or a consolidation with a clear liquidity above or below. And I don't want it to be trending in a clear way. No, I want it to be a range. I prefer to see equal highs, equal lows with the PM session range. And price comes back into the range immediately. So I want to see a very small fake out. Price taking the liquidity, which is the manipulation, coming back into the range. there is no displacement to the upside or downside above or below the PM session. And finally, I want to have, as we discussed in the first example and last example, I want to see a fair value gap above or below PM session high or low. So if I want to go short, then I want to see a fair value gap above the PM session high to go lower, and the opposite when it comes to the low. I want to see a fair value gap below the PM session low to go up. Why is that important? Because if price takes the liquidity, this is one sign to go up, but another sign and another support for price to go up is a fair value gap below that